Hey everybody, this is Dennis Wilborn, the founder of Active Trend Trading. Welcome to this video. This is a special video that I put together and did a webinar on, and it's about what do bear market bottoms look like, what the characteristics, the personality, that kind of stuff. Is to help traders, one, be patient and wait for the bottoms to happen, and secondly, be poised so they can take advantage of the absolutely fantastic buying opportunities when the markets finally do bottom out. Hey, if this is the first time you've visited us on our YouTube channel, Market Tech Talk, please hit the subscribe button. It's right down there. Hit the bell and also give us a thumbs up if you like the content. Please watch the video all the way to the end. I have highlighted 5 stocks that are doing exceptionally well in this bear market, the bear market of 2020, and they can be poised for a big move after the market comes out of the bear. Aloha, God bless, enjoy the video.
Yeah. Anyway, I just want to say aloha. I hope everybody is on the mainland is being safe. Mark, I hope you are also here in Hawaii. And we'll get jumping into today's session here, just the special training session on what bottoms look like. Okay, good afternoon. This is Dennis Wilborn. I'm the founder of Active Trend Trading. We'll jump right into today's session. There was a little bit of a technical hang-up. We're switching over to the YouTube channel, and that's okay. We'll post that up a little bit later. I will make a little bit of a spill for the YouTube folks when they do take a look at this video. If it is the first time you're seeing us on YouTube, we'd love for you to, one, hit the like button and also hit the bell and the subscribe, and just let it know you want updated when we put new content on here. I have a whole bunch of training content on the YouTube channel. And also, if you want to get other notifications of what we're doing on YouTube and at Active Trend Trading, please go ahead and subscribe. You can also go to our website, and I encourage you to watch this video through to the end because I'm going to be covering 5 stocks that are holding up stronger than the rest of the market, that with this market, the bear market we're in, will potentially have a stronger uptrend or a stronger rebound after when the market does reset itself. So let's go ahead and get started. One of the reasons I wanted to do this session is to basically let people, I have been getting a lot of questions by folks saying, hey, Dennis, what's this market doing? When's it gonna bounce? Is this the time to buy? And all that type of thing. And so the answer to that question is, we don't know yet. I mean, we are clearly in unprecedented times. The drop over the last 4 weeks, while it is not the largest drop in the market, has been one of the historically fastest drop in the market. And again, if you do have a question or a comment, please put it in the chat box. And my son Brandon, who is now online, will basically help answer those for you. So we're on unprecedented territory. However, if we go back over almost 100 years to 1929, when we had the great, when the market crashed, that everybody talks about, the market crash of 1929, threw us into the Great Depression for the United States. There have been multiple times through that time frame where the market has reset itself, and that's where we're at right now. We're in a level where the market is in fact resetting itself. And so what is that going to look like? And I'll remind everybody that all the materials we do present is for training purposes. We make no recommendations. So how did past bear markets end? That's one of the things that we want to take a look at, because typically, due to human psychology, price patterns in the market tend to repeat. They're not exactly the same, but they do repeat. So bear corrections and bear markets reflect human behavior that leads to buying opportunities, and sometimes these buying opportunities are buying opportunities of the decade. Will that happen again with this bear market? Yes, it will. I mean, when exactly, we don't know. All bear markets are not identical, but all bear market price patterns have similarities. That's what we're going to take a look at this evening. What are the similarities? Each bear market in the past led to a market reset. And when I say a market reset, what I mean is that basically the sell-offs led to a point where either new stocks came on board, new leaders came on board at very wholesale price levels, where a person, if they made a choice to get on board, then they could ride it up through some of the larger gains. Go back and take a look at Apple, what it did back in 2007, 2008, or even go back further than that. What did Apple do in 2004 and before its big, huge run up? After every market, bear market, new leaders emerge with new buying opportunities, only seen every decade on average. Since 1929, there have been over 15 resets of 20% or greater and 9 actual bear markets. We are currently in one of those bear markets. So what does a bottoming action have? What do they have in common? Well, one, before you start to compare bottoms, and I mean that in a totally good way, is remember averages are just that. Bear and bull markets can be either longer or shorter than the average. And so just be aware that when we talk about averages, things can run longer on both sides. As we take a look, an example of that, the bear market that just started, the bull market that just ended in 2020 was actually 11 years long. While the average bear market, bull market runs for about 6.5 plus years. Well, clearly it was well over the length for an average bear market, but it's still within the realm of the distribution for the average. So just remember, averages can be either longer or shorter. 2, 1, learn to recognize price action characteristics of bottoms. There's some strong similarities in this that you need to take a look at. And when you see those, what it will do is it'll help you become more patient as you wait for the bottoms to work their way out. So what do these have in common? 1, we want to go in and we look at the charts, and I'm a chartist. I basically have been trained in technical analysis at the master's level, and basically the technical analysis on the charts reflect all of the emotions, all of the reasons why people invest. The greed, the fear, everything that's going on. The charts will reflect that. I can guarantee you that, 20 years from now, people will look back at 2020 and, not remember the coronavirus for the reason why the market's falling out of the sky, but what they will remember, all they'll be able to say is something happened there that impacted the market. It reacted to the downside, and that's all they need to know. And that's the other thing I love about technical analysis. I see some old names on here that it's really nice to see you guys. Anyway, Eddie, good to see you. Gino. On every bear market, when it hits its ultimate low, there will be a retest towards the low. We'll take a look at that. Momentum, I always look at a momentum. We want to see a shift in momentum. And there's several ways to look at that. A couple of the indicators I look at, of course, is the true strength index and the market forecast. They show me the internal momentum of what's going on with the price action. We'll see those in the charts we take a look at. And I also want to see some reversal candlesticks. Now, if you don't understand candlesticks, that's okay, because it's these upper, that's the 4th in the priority list of what I'm looking for. And I only look for a few. And so, there's over 250 different candlestick patterns. I look for 6. That's it. And that's the way we simplify things at active trend trading. Some of the observations I've made. 1, we know that a bottom is finally in after the bottom is in. And sometimes we don't know for weeks and or months after the fact. 2, new leaders emerge. And one of the things we offer through Active Trend Training, of course, is we do the Power Rank Elite watch list for people who, for members who are just free members. There's no charge for that. And then for members who want to start learning a little bit more about investing, we offer what's called the Top 5 Plus watch list. And that's the top 5 growth stocks each week that I pull off out of the research I do on over 500 and plus stocks every week. And then that goes out to the members on that. But let's take a little bit of history. Let's take a look at the history of bear and bull markets. This is a good place to take a peek. Let me check in real quick before we proceed on. Brandon, are you okay?
Yeah, I'm cool.
Okay, cool.
I wasn't sure if you wanted me to chime in at any point or if
Son,
you were just rocking and rolling.
You take after the brilliance of your mom, and so you can chime in anytime you want to. But right now, be quiet.
Okay, I won't suckle the air out of the room.
Okay. So, hey, history of bear markets, and this goes up through 2018. Of course, we're 2 years past that, but on average, I want you to take a look at. Just to remind me, Brandon, when I start moving my. I get really excited when I present sometime, guys, and my my cursor just bounces around all over the place. So if that is, I will try to control that. But as we start looking, now this goes back to 1926. We had, nice uptrend. The market had just really speared up. And then we went into this was the Great Depression years. We had an over 80% correction or bear market. It followed shortly after that with a little spike up and then another fall. But over this time, the average bull has lasted 6.5 years. The average bear has lasted a year and 1.3 years. And now, has there been times that they're longer? Yeah, but bear markets tend to be short in nature. So that's one thing we can count on. We just have to learn how to be patient. For some of us who are entering our golden years, of course, we may have missed other opportunities to get involved in the stock market. Maybe we were impacted by the 2008 stock market and the stock market crash back then, and the bear market where, our 401ks were cut down to 201ks and they just got back to, being 401ks again. Well, hopefully you did get out of the market in time. That's one of the things we did do for our active trend trading members is we moved to cash back in the last week in February. So we missed about 27% of the drop on the S&P. So again, bulls, bears, how many and I've counted out all these across here, and there's approximately now with the one today is 9 bear markets since that time frame. So let's take a look a little bit closer into looking at those. This is a chart of...
Reach back to that chart there real quick if you would. I just want to point out, they've got these little gray bars in there that are supposed to represent recession. And while we can debate when the Great Depression actually ended, in general, some of these recessions, what you might notice is that the market turns around right at the end of or even before the recession is actually over.
Yeah.
And so that's, watching the economic data may get you in behind the 8 ball on the next bull market.
Oh, without a doubt. That's why of course I'm a technician, Brandon, is because we will know early. We will know off the charts before the news hits the news lines that something is going on. Great point. Thank you, son. And so what Brandon is talking about, let me highlight it to everybody. He's talking about these little boxes down here. That was what's considered a recession during those little skinny ones. And as you can see, the recessions typically they're painful as all heck. Just like I'm sure that those of us who are hunkering down in place due to the coronavirus, yeah, it's going to be painful. It may get really, really ugly. However, they tend not to last a huge long time. I'm very thankful that our economy had gotten as strong as it did get prior to this, this market crash, because I think that's going to enable us to climb back out of it much more quickly. Yep, market is a leading indicator. You're absolutely right, Mark. So let's take a look at what we're looking at. And one of the things I want to highlight, and I took this snapshot, we may have actually dropped a little bit lower. This snapshot was taken earlier today. This is a weekly chart, the bear market of 2020. From high to low, in other words, this high here to this low, we have dropped 30.25%. As I said earlier, we basically jumped out of this market and have stayed out because we haven't got any triggers to get back in right at that point right there. So in other words, all of this 25% drop from there to there, we just didn't partake in it. And so we're sitting on cash. We're ready to invest. However, we haven't got the triggers to go in. But one of the things I wanted to start looking at, of course, now I tell us to, one, look for past lows. Well, in this particular case, and I'm going to show you that we're at the leading edge, the hard right edge of the chart on 2020. We do not know what is going to happen over here. Is it going to go further down and then bounce? That's a potential. But regardless, if I break through this level, I still want to look back over here. Why? Where did it fight its battles before? That's exactly what I want to be looking for. And so as I look to the left, what do I see? I see a level of, this was the bounce from 2018 from the short, and they didn't really count the 2018 drop as a bear market, but it did correct in a little bit over 20% in just a few weeks. And so I want to look to the left. This is a line of demarcation. If I drop below it just briefly and bounce back up through it, that may be a trigger signaling me that we're ready to go back into the market. Then I can either trade the indexes, the index ETFs, such as in this case it would be the SPY, SPY, or I can look to trade individual growth stocks that will rebound with the market.
The S&P today finished up exactly the way you described.
It did?
The low, well, your price there was 23.86. It dropped 100 points lower, and then finished up at 24 almost.
Yeah, I think the S&P today fell here and then finished there.
Yep.
So excellent. So look to the past. These past lows are important too. Once we do put in a bottom, then we will retest towards a low. Price action will retest. In other words, prices will then pull back towards the low. And so what is it? And again, we'll look at individual charts going back at past. Momentum. I want to see either a turn up on momentum, and I'm always showing TSI on this. I want to show a move up off the bottom on momentum, or I want to show what's called positive divergence. You'll see an example of that also. And then number 4, I want to look for reversal candlesticks. And based on this chart, the way I see it right now, we have no reversal candlesticks. I do not have, there's a lot of things I don't have. The only thing, that I do have is I'm basically testing at a previous low, but I have not had any retest or anything like that. So I can say to myself, okay, I don't see what I need to be able to get into this market yet. So let's take a look. Let's go on back and look at some other bear markets. Well, let's start at the mother of all, well, what we think is the mother of all bear markets, but it may not be, is basically the bear market of between 1929 and 1932. Now, while some of you may think I was around back then, no, I was not. But a lot of our parents were. They basically, my mom was born in 1930, so she was a Depression baby. And from this high here to this low, and it took a little bit over 3 years, was 86%. Now, we certainly don't want that kind of thing to happen to us in our markets today. But again, we want to do the same thing. We want to look to the left. Now, on our charts, and the charts that were available through the charts that were available through Thinkorswim, they don't go far enough to be able to say, to allow me on this particular chart to look back to my left. But I would want to do that first. I want to look back to my left. Is this a level of past support? That's the question I want to ask. 2, I want to see a move up and then a retest. Now, you may get distracted briefly by this move up here and then a pullback. But in reality, what happens is we get a little bit of a bottom here, and we get this initial retest, a small retest. The small retest back up towards the moving averages, a pull back down into this level here, and then a bounce. That's one of the retests. The second healthier retest, of course, would be the retest where price action pulls all the way up to this high up here. A couple of things this tells me. I broke a past high. I may be moving back into a uptrend. So I took out a past high. So now I have a higher high working. And then for the next July through April of 1933, price action just kind of moves sideways and kind of sloppy. But look at the range here, folks. The range from the high, which is about $8, down to the low, which is about a little bit over $2.50, that's a pretty significant drop on its own. However, it stops. Now I have a higher low, hence the ingredients for the next uptrend. So that's what I'm looking for. And again, the patience aspect of it is telling us, stand by, the momentum has to shift, which in this case you see it shifted here, it did shift here, but then rolled back over, went underneath moving averages, and then I look for a reversal candle. The data back from 1933 timeframe doesn't give us really good definition on what the candlesticks are, and so really hard to judge on that. But as you see, that's one of and so the thing to remember from this is this. One, we get a pull down to a new low. We get a bounce up, recovery, pull down to a higher low. So in other words, here's the retest towards the lows. This time it didn't get all the way down to the low, and then we bounce higher from there. That's one of the patterns that we're looking for. And I wanted to show you this chart before we moved on to the next bear market. And the area and time we were talking about is right here, the Great Depression. And as I said, if I had the charts that went all the way back, this is a chart of the Dow, or the Dow equivalent that goes all the way back to 1789. So if I look at this past low, 1932, does it line up with a past low? Just draw your line across here. No, that's not a line, Diddy. Excuse me. Okay, there we go. So we'll just draw a line straight across. Again, it would be a look to your left on a straight line. And sure enough, this low from 1932 lines up with a low and a congestion area back between 1896 and 1903. So it was testing a past level of support. And we'll see that that same pattern continues to repeat itself on the future bear markets that we take a look at. So here, 1947. It was just after the World War II had just come to a close. The market went into a bear market, and it dropped 28%. And where does that measured from? That's measured from this high here down to that low right there. So again, if we take a look, apply the same information, look to your left. This lined up with, well, not only this low here, but one further to that. So we look to the left. We look to the left, and yes, we are in a level of past support. What are we seeing here? What's the next thing we want to look at? One is retest towards the lows. And so we pull back up, we come back towards the lows, back up, and we actually just bounced around for the next almost 9 months. We retested back towards the lows right there. Momentum, positive divergence. We get a little bit of momentum here, retest, positive divergence. One of the other things to note on this that made actually a trade right there would have been okay is that we have some additional, let me get a different color here. From this low here to this low here, these are lower than each other. This on the turn for momentum is showing that even though I am making a new low here, my momentum is not. My momentum is actually positively diverging from my price action. This oftentimes is a real strong clue that the market is going to turn around. But remember, take a look. How long did it take for it to get in that condition? Well, from October till about June. So that's about a 6-month period of time. So again, it reiterates.
That looks a heck of a lot like the Russell last year.
Yes, it does, doesn't it? Be patient. So anyway, then it gets a bounce, and let's see what else. Reversal candlestick. Here, the candlesticks are starting to show up a little bit better. You get a nice little reversal candlestick here. This would be called a piercing line, basically pushing up through halfway of this big red mark, which is a candlestick reversal signal. Then over here, you get another one, a bullish harami, right here, telling us something's going to be happening. Now, if you don't know some of these things, and I recognize that, if you're just getting started in the market, you're not going to know some of these things. So that's what part of the thing that I do with my service. I help you learn about those things. We offer some classes and that type of thing, but at the same time, I apply these analyses to every time I'm taking a look at individual stocks and or the markets to provide information to our members. So 1962, where were you in 62? Another entity here. So a 29% correction, bear market, and this went from this little red arrow here down to this little green arrow here. Well, let's take a look. What are we finding out? Well, we again get a bounce up from the original low, a retest back. And again, how long did this take? Well, this took, there's a quarter there, so that's 3 months, 4 months to get the retest. And then from there, it was off to the races after 62. Which is very nice. But it did that, and so we also had, it did kind of come down and retest these past lows. So this was indicative. The more clues you can pile up when you're getting down to a low, the more you can say, oh, this is a strong signal. That's a strong signal. And so I want to basically be ready to kind of load up the truck and be ready to trade up to the upside. We had a nice 2 bullish reversal signals, one here on the retest. That's a hammer. one of the most significant candlestick reversal hammer, because it looks reversal signals available. Again, you can see it looks like a hammer. Hammers only, well, you may see candlesticks that look like hammers scattered throughout here. They only take the effect of a reversal signal if it's at the bottom of a downtrend, and that is a multiple week downtrend. Hammer, next week, bingo, bango, away she goes. So again, retest old lows, yes. One from there, and again, this level, also you can go back further in time and find that same level to move up on. Momentum divergence, in this case, yes. Reversal candlesticks, in this case, yes. What about 1970 to 1971? Again, our drop in 1970 to 71 started back here. Actually started in the November-December timeframe in 1969. Fell from the skies. Okay, and fell 37%. It looks like it's further than, because it's all comparable. Looks like it's much further than the other entities, or some of the other charts, but it's only 37%. Not that 37% is not enough. Again, we look to the left. Now, if I'm sitting here, if I look to the left, there was support over here, but if I'm waiting for the retest, my retest is just simply this. A bounce up from this selling into the moving averages. It fails. That rally attempt fails. Then I get my retest. So again, how long did it take for the retest to take place? 1, 2, 3, 4, 5, 6 weeks. So a month and a half. And then it went into a rally mode from there and continued on. So retest the lows, momentum positive, and in this particular case, yes, as it did this retest, momentum had shifted up. Momentum never broke down in this particular case, so it maintained a positive divergence through this reversal. Can everybody see that positive reversal or positive divergence? Brandon, is that clear?
It's a little bit of an unusual one because it's not a separate bottom.
Yes,
like we've been pointing out before, and so sometimes that's not as visible. I haven't come up with a name for it, but it is something that I've seen that can be sneaky but powerful.
Yeah, well, one of the great things to call it is you can call it the TSI squeeze.
Okay.
Because what happens is right there, you can see how it squeezes back together but doesn't cross back down. It squeezes towards the longer term but doesn't cross over.
I see what you mean there, yes.
Yeah, squeezes towards it but doesn't break down. So in other words, on this particular bottom in 1970-71 timeframe, you actually had 1, 2, 3 individual opportunities to get long this market, and before it finally did its final breakout to the upside. So really interesting stuff.
Yeah, I've always thought of it almost as like sliding divergence.
Sliding divergence.
Instead of being a separate low, it just kind of keeps going, tracking up, even if the indexes or even if the price action is tracking down.
Yep, I like it. So here, 1973, 1974 bear market, 49% drop. Then it goes back to it actually finished up in 73 after a nice run, then went into another retracted session. Now, part of this, I won't say that it was due to I won't say that this recession was due to the ending of the Vietnam War, but that could have had something to do with it. But anyway, we draw back 49%. That's from this high, the red arrow here, all the way down to just past the green arrow down here. And if you're wondering about these arrows, they're basically just telling me when my TSI is crossing over, is all it's doing. So, so I want to look for the past lows. Again, if I see this is the initial low, we get a bounce up, and it looks very similar to the one earlier, 70.71. I retest towards the low, again, bounce up, retest, almost retest on to the absolute bottom, and then it rebounds from there. It looks very similar. And remember, this move from here, some can say, you know, you can either say that this is a positive divergence here because you're testing down around the same area, or you can just say, hey, the TSI has now started in an uptrend. And that's one of the reasons why I use the TSI, because it puts in its own patterns. Uptrend, and therefore it just bounced, and it bounced again here on other that doesn't go there.
I was going to say, while you're at it.
What?
While you're at it, why don't you show the little downtrend line with where the break happens on the other during the downtrend.
This one?
Yeah, the TSI has a nice downtrend line.
Okay.
Which once it breaks,
my presentation drawing things just blew up on me. Hold on a second. Hold on.
Try duct tape.
I know it. Well, it's just one of those things where just putting through a lot of bandwidth today. So I'm assuming you're talking here.
Right.
Yeah. Again, that's another reason why I like this. Then it does another one here, and actually when it drops down below that, and then takes back up, then I can have another one here. That basically timed me out at the top, but that's beyond the scope of what we're talking about here. We're talking about bear market. So that was 73, 74 reversal candlesticks, a whole bunch of them. Almost, you know, a bullish engulfing that engulfed all of this past action here. Huge. This was a wide-ranging volatile move. This was a little bit more under control. That's one thing to also keep an eye on when you're looking at bear markets right now, folks, is when you see these huge candlesticks like or huge price ranges like we have in today's market, that is a market that's basically out of control. There is no uniformity. When it comes back under control, reflecting its basic, you know, underlying personality, is when the price actually starts to get smaller, and then you start to recognize patterns, because when you see those big ones, there's no pattern there. And so that's another thing that we're kind of waiting for at the bottoms. 1987. Now this was the market crash in it was a fast market crash. Kind of similar to what we're seeing right now. In that it fell very rapidly. 1, 2, 3, 4, 5, 6, 7, 8, 9, about 9 weeks worth of action to the downside. It fell 35.94%. You will hear people talking about the, you know, I think it was Black Friday or Black Monday, that some of you historians, was it Black Monday or Black Friday in October?
Wasn't it a Tuesday?
Huh? Or Black Tuesday, could have been. Well, the market just, you know, it was in October. It just flash crashed. That's when they first started using the term flash crash. Fell out of the sky. However, got traction fairly quickly. Again, we go back and just do the retest here. Look for past lows. Hit the low, bounced up, came back. We actually didn't get any, you know, we did not get a TSI crossover here. We have one here with a bullish reversal signal. In this case, it is a piercing line again, and up it moves. This time, you know, and you get multiple of these tests. So we pop down here, we move up rapidly over a 2-week period, pull back towards the low, and that's the trick. And then once you get the reversal off that, that's the reversal to get in. Now, after you get the initial move up, we do get another pullback towards the low. But by this time, we are starting to settle into a series of higher highs, higher lows, and we're off to a larger gain back up to the past gains over here. So one of the things, and I'm kind of wondering about our existing bear market, because it's happened so fast and so vicious and violently, will we get some kind of a similar type reaction where it won't last a long time? I don't know. You can make a case either way, and just remember that when a person does make a case either way, it is an opinion. The only time we're going to really, Black Monday, thank you, Mark, the only way we're going to typically know is after the fact that we are. Now, however, we can take the clues, and that's what this presentation is about. Take the clues and utilize those to start wading in Black Monday. Thank you. Tuesday was in 1929. Thank you. Is to tell us when we can start wading back in. And the 2000, this is the dot-com bubble from 2001. The drop 50% from this high here to this low here. This is an absolutely beautiful chart to be studied. I would suggest going in and taking a look at this, study this chart, because it shows a really excellent downtrend that in fact could be traded. Downtrends are hard to trade, but then its reversals were amazing. Now, why do I say that? Well, look to your left. If you hear me saying that a lot, it's true. Look to your left. What do you see? I'm testing a former low. What else do I need? Well, I've retested. Momentum. What's momentum doing on this retest? This is really classy. Excellent positive divergence. Excellent positive divergence. We get another one over here that isn't quite positive, but it's close enough. That is another retesting before away it goes. You can almost consider this when I remember trading in this particular market, people were talking about the potential of a triple bottom 2001 for the recovery. That's exactly what happened. And so it can look like that. And then bam, away it went. But each time it fell down, the thing to remember is each time it fell down into these areas, yeah, there was a place to nibble. And in this particular case, it bounced back up, failed to break out or break through this downtrending dynamic, those moving averages, you can call them dynamic lines of support and resistance, failed to break through the dynamic resistance there, fell back down, popped back down, and then popped back up, finally broke through, and it was off on its way. How long did this bottom take to work out? 9 months. 9 months. Again, were there reversal candlesticks? Yes, there were. Hammer, bullish engulfing, a bunch of little hammers. And one of the other things to look at, folks, is when you see these long tails, and I don't know how many of you used candlestick charts, but if you do, when you see those long tails like that, that is telling you that buyers are coming in, it's reflecting. So meaning that this level of support is a strong level of support, because that's where the buyers are saying, hey, I will support the price action at that point, and it's not going to go any lower. And those tails show buyers came in, pushed it up. And they did that 1, 2, 3 times in this particular situation. Were there some fake outs? Yes, there was. These long tails here, they were looking for that level of support. So 2008, here's the bank. This is the housing bubble burst. 2008, 57.69%. That is the fall from up here. This was in October 2007. It lasted until this low here back in March of 2009. Some of you probably remember this. Some of you may have been impacted with your 401ks in this situation. But again, we look to the past, look for the retest. In this particular case, when we look to the past, There was some support over here. You can go and look, check it out on your own. But we also had, what do we have going on? New low and an excellent positive divergence here. And then the price action becomes much more uniform. And oftentimes, some of those times you're going to have to wait. If you miss that move there or there, I would, suggest you may have to wait unless, with our active trend trading, we do show folks where other places, alternative areas where you can enter, like there, to get in. But you may have to wait for the pattern to complete itself up to the top and then do a pullback and then enter here for the rest of the move. So this again, we look to the left. We found support. We have very positive divergence, excellent, and we have a reversal candlestick. Again, same patterns or similar patterns. It's not the exact same, and I hope that's clear to everybody. It's not this exact same, but they're similar. You can tell that they're related. It's like they're first cousins or something. So, okay, that is 2008. We already covered today and what happened in the market today. Let's take a real quick look at the live.
Hey, Dad, can I just ask? I mean, I hear a lot of people talking about, U bottoms and V bottoms and W bottoms and things like that. And I wanted to, it's a question about the 1918 pandemic. But I mean, I would say that this 2008 one is the closest we see to a real V bottom, and the rest of them are more prolonged, let's say.
Yeah.
And so I think it's worth pointing out is trying to predict that sort of thing ahead of time before it actually happens. Like you said, you know the bottom is in after it's happened.
Yeah, I mean,
and trying to guess it beforehand is fool's errand.
It is a fool's errand. I mean, the people who, you know what they call people who try to pick bottoms? Broke. What, you thought I was going to say something else, Brandon?
I was not going to guess.
Okay. Anyway, hey, let's take a real quick look. I want to bop over and just take a look at a live shot here of the, there's a weekly and a daily on the S&P. And as you can see, here was that level we were talking about, this in what Brandon was talking about. I said, look to your left. Well, look what happened here. How? We did undercut that level, and now we are breaking back up through that level. Is based on what you see, are we positive or are we negative? Well, one, we've got some positive divergence here in that here's the low from up here, way up there, and we're breaking up. The TSI has not rolled over to the low. Market forecast, the big green line there is also starting to kind of turn up. So I'm anticipating that we're getting close to where we could potentially get a reversal and a buying opportunity going into the S&P, into the NASDAQ. And as long as we're looking at, let's take a real quick look at the NASDAQ.
Initially, though, that opportunity might only be up to the averages, though, right?
Yeah, and I want to show that to folks is basically what we're having is, again, this is the weekly chart on the left. Look to your left, and what do we see? There's a low, and the today's action on the NASDAQ did the same doggone thing. How about that? Mark, are you making fun of Brandon and I? And what about the Russell? Oh. Now, Russell, I mean, has been taken out behind the woodshed, is just getting the heck beat out of it. I have to actually go over to a weekly, not a weekly, but a monthly chart. But look what we're coming close to here. Let me get rid of that. You don't need that. I don't want to do There we go. As you can see, I have highlighted here on the monthly chart that past low. Again, I want to be aware. Am I getting some positive divergence? No, not yet, but I'm getting this way overextended. So did the Russell bounce with the same vigor as the other entities? No, they did not. No, they did not. No, it did not. So
what does that mean for regular folks? I mean, for people who are just trying to protect their stuff and their retirement accounts, what does that mean that this didn't bounce more vigorous or as vigorously?
Well, what it means is I would, it means a couple of things. One is that the Russell, which is small cap, you should probably want to avoid that, avoid small cap stocks until we get some kind of a rebound off of this 943 area. But as you can see on this weekly chart, we have no, there's no structure here. There's nothing that say, when I say structure, what I'm looking at is these ups and downs. That's structure. Here we just have destruction, selling out to the bottom. It has not made an attempt to bounce yet. And so until it makes an attempt to bounce, I would stay away from the Russell and the stocks that are in the Russell. So that's what that means, Brandon.
Thanks.
Now, might that change? You betcha, it might change. But as Brandon was saying earlier, let me pop back over to the, let's go back over here really quick to the, I'll go over to the NASDAQ. Okay, based on what we've learned from today, what can we count on, or what can we probably count on? We can probably count on a rebound and then a retest. So what does that look like? Well, let me define an area, what we'll call an area, a zone of value, which was basically right up here between those two moving averages. The top red one, that is the 20-day moving average. The next one down here is the 8-day moving average. Oftentimes what we'll get, we'll get a bounce back up into that area, somewhere in there, and then it'll roll over and fall again. Now the question is, are you going to try to trade from here to there? That is a challenging trade to make. Challenging trade to make. But it's, it is doable. We do watch that at times, but again, it looks like the markets are trying to set themselves up. It's trying to find a bottom. So let's take a look. Okay, so how did past markets perform? Now what I'll do is I'll just give you an indicator. We basically clarified, look to your left to find past bottoms, past areas of support. Once we have the initial bounce up, in other words, we've dropped, we get what we think is the initial bottom, it's going to rebound, and then it's going to retest. Oftentimes, this retest, that's when we want to be paying a lot of attention, because oftentimes it's the retest where we can plan on, plan our trades around the retest. Why? And it makes it a good place to plan the trades, because if we break further below this, if I try to buy here and it breaks immediately, I'm really close to my stop loss, and so I can bail out and say, okay, enough's enough. I'm done. I'm out of here. So it basically dropped. Or another thing that may take place is we do that retest actually turns into an overshoot retest. Price action drops all the way back down below this level and then starts building back up. And then what we'll do is get another retest. And let's say this time it stays above this level, stays above this level. That's our first indication that the signal may be reversing positively, because that's a higher low and the move up here. Now, if price does do this on you, If the momentum, which is running around down here, has come down, hit a low, popped up with that, and then came down and hit a higher low and moved up, that is also an indication that that could be a good place to look at trying to buy. So that is basically the patterns we want to look for in how a bear market ends. Last but not least, so the conclusions as we look at characteristics of bear market. Bottoms is one. They will always retest towards the market low. That is, again, I highlight that, retest towards the market low. The retest can require weeks and even months. And so it pays us to be patient. Don't go in, big into any trade. Basically, let the market and the technicals pull you in. And if if you don't know how that works, look for somebody to help guide you through that. If you want to become an active trend trader, that's great. Because we, basically I do the analysis and I actually send out text alerts telling people where I'm going to be buying for the premium members, where I'm going to be getting out, and also updates with other training to when we're staying out of the market, like now. Recognize that counter trend trades can be very significant. If you go back to 2008, there was almost a 30% rally in the S&P. It was about 20 to 30% in the S&P in the last 3 weeks of December. So while it was a total against the primary trend, major trend move, these moves in a bear market, the up moves, in other words, the recovery rallies, they can be significant. But we want to be able to keep our stops and our profit targets well in range. And so how do I do that? And I'll just give you an idea how I do that. Is basically, I say, if this price action on this stock or this ETF goes up 10 or 15%, get me out. And I'll have a stop loss down, where it's no more than 5%. So I'm looking to make 15% and willing to, I don't want to risk any more than 5%. So that's a 3-to-1 risk reward ratio. So I want to start looking for stocks that hold up better, that are holding up better than the indexes. So again, lessons, remember, look for past lows, look to the left. Expect retest towards the low. Be patient as those retests work out. Momentum, positive divergence, when that shows up, that is a confluence of clues saying that this next move up could be significant. Lastly, I want to be looking for candlestick reversal signals. I will be doing on YouTube, I will be doing a presentation on candlesticks, the primary patterns that I look for in the very near future. So here's kind of a plus for everybody. This explains the, if you will, the emotions that go along with the move in the market. One, how it takes off, and how initially, and it's not a particular stock, but the initial takeoff, nobody knows about this over there. This is when it's prior to the IPO. A lot of times the smart money comes in here, and smart money is the initial capital investors in the market. Then the institutional investors may get interested in it, and it takes off a little bit more. It goes into what's called a bear trap. That's the first initial sell-off. Then if it is a money maker as far as the stock goes with good growth, great growth, it runs into a situation like this. Now this time here can be not only, it's going to be normally years, about 3 to 5 years on some growth stocks, but then it finally hits its peak, rolls back over, bounces, and you're expecting it to move all the way back up here like this, but instead it doesn't. They call that the bear trap. It tries to rally back up to the highs, fails, which we've just seen in the market, rolls over. And right now, I would say we're in the later part of the fear stage. Capitulation has not happened in the market yet, as far as I can tell, which will drive us all the way down into despair. And so, but you don't have to despair now, because you know how bear markets bottoms work. Do you need all four, or will three work? Are you talking about the four items I look for, Gary? Yeah, yeah, that's a great question, and the answer to that is yeah, without a doubt. If I can get two or three to line up and be confluence of clues, then that works well. And if I have the ultimate is the price action has got to trigger me in. But those are the clues that I'm looking for. So as I promised, here are the 5 stocks that I think have a potential of really doing well with a rebound in the market. The first one is Zoom, ZM. This is a, well, what we're doing this particular webinar on. With everybody, being forced to not, what do they call that, Brandon? Social distancing or something like that?
Shelter in your bunker? What? Shelter at home.
Yeah, so I think it's social. I was at Costco yesterday, and I said, make sure you stay 6 feet away from people.
Yeah, social distancing.
Social distancing.
So
with that,
for some people, that's their preference.
Oh yeah, yeah. But I'm a hugger, man. I like to hug people, so it really bugs me. But anyway, hey, Zoom, excellent potential stock. Another one, ZTO. This is a Chinese stock. On a recovery, and it looks like the Chinese maybe start coming out of this a little bit earlier than us, so ZTO may give you some options. Netflix. If people can't go anywhere, they still need entertainment. And some people like to turn to Netflix. I'm not really a person, I'm not a real big Netflix fan. However, the price action on its chart does look pretty good. Amazon. People are we moving into an area where people are going to stop going out shopping for a while?
Amazon is reportedly hiring thousands and thousands of delivery people.
Retiring.
So they're prepping.
They're hiring 100,000 factory or warehouse workers. How about that? And then last but not least, Myrna. Myrna, MRNA. They are on the cutting edge of some of the coronavirus potential vaccinations. And so, again, I would look at these three. I'm not saying that, don't go out tomorrow and say, hey, I'm going to buy some of each one of those, because we want to actually watch the price action. If you want to know when I'm going to be getting into it, of course, you can, look at the top, becoming a top 5 member of active trend trading. So that's where I'm going to leave off. And so any questions? Brandon, I'm really proud. We did that in an hour. Okay, if not, I want to say thank you guys for coming on board. Again, I see some of the names on there. Eddie, how you doing? Good to see your name there. 1918. Nira Parjet. Rick Berry. Hey, Rick Berry.
Eric, what are you asking about 1918?
Are you talking about the movie?
I think that was 1917.
Oh. Previous chat, Brandon.
Oh, somebody did mention in the chat box about 1918.
There was a flu pandemic was in 1918.
Right, but being potentially a market similar, kind of a way to look at this one. And looks like it was a brief pause. I mean, I just looked real quick at a chart when they asked about it, but it looks like it was dropping from 1916 from World War I. Paused dropped, paused in a brief, bear trend rally, and then the flu pandemic knocked it out about 20 more percent. It turned around and took off 50% to the upside after that. The flu passed, but then continued on down into 1920 to be a pretty significant, like 60% drop potentially.
Yeah,
and then of course you get the Roaring 20s before 29.
Yeah, and then everything went nuts. So, but one of the things that we could look forward to, potential, again, opinion only, this is how something could turn out, is we could get into a situation where these little 25, 30, 40% upticks or run-ups in the market become the norm for several years. Because there's a lot of questions that have got to be answered about what's going on with this pandemic right now, and I don't think we've gotten to the place where we're answering all of them, and that is not the intent of this particular meeting. But I could see that the volatility could last, for a good 4 to 5 years. Again, that's an opinion. So, hey, I want to thank everybody for joining us. Thank you a lot, Brandon, for being online with us. If you want to find out more about active trend trading, you can also jump in. Please subscribe to Market Tech Talk. That is our YouTube channel. I upload new content that every week. We do have a training curriculum going on with that. I'm building up some additional videos there to teach people how to trade the market. You will, as you look at this end card, there will be a floating icon that drops in about here, and that's how you click that, and you will find out more about it. So until later, if you do have any questions, guys, send me an email or send me do a messenger for me. And with that, I'll bid everybody adieu. Brandon, thanks for joining in. God bless everybody, and aloha.
Aloha.